Today, we are cracking open an absolute legend in the investing world, Seth Klarman's Margin of Safety. Now, this is a must-read for any serious investor, but here's the catch. It's been out of print for decades. Used copies? They sell for thousands of dollars online. So what's the big secret? Why is it so valuable? Well, we're going to distill its core wisdom for you, and it all comes down to one thing: how to control your downside. Just let that sink in for a second. This one sentence from Klarman completely challenges what most people think investing is all about. It's not about being a genius, it's not about predicting the future, and you definitely don't need a crystal ball. So what's the real secret? It's survival. That's it. The best investors, they don't win by being brilliant all the time. They win by avoiding those huge, fatal mistakes. They focus on not losing, because if you can just control the downside, the upside, well, it pretty much takes care of itself. Okay, let's dive into this. To get started, you have to understand that Klarman, a lot like his mentors, Benjamin Graham and Warren Buffett, draws this really hard line in the sand. He says that when you look at the market, people are playing two totally different games. And the distinction he makes is crystal clear. An investor, they're analyzing a business. A speculator is trying to read the minds of the crowd. You see, an investor is buying a piece of a company's future profits. A speculator, they're just betting on price movements, hoping and praying that someone else will pay more for it down the road. And here's the crucial point. Trying to outguess the market's reaction to news is, over the long term, a losing game. Why? Well, because you can never, ever be sure what information, what hopes, and what fears are already baked into today's stock price. This brings us to what might be one of the most powerful ideas in the entire book. If you really want to invest like Klarman, you first have to unlearn everything Wall Street and your finance professor probably taught you about risk. You know, the common textbook definition of risk is beta. Basically, it's a measure of how much a stock's price bounces around. So a stock that swings wildly is called risky, and a really stable one is called safe. But is that actually true? Klarman does not mince words here. He says this academic view is not only wrong, but it's dangerously misleading. I mean, a price going up and down doesn't tell you a single thing about the underlying business or, more importantly, the potential for permanent loss of your capital. So here's his super practical business-focused definition. Real risk has two parts. First, how sure are you that this company can generate cash in the future? And second, what price are you paying for that stream of cash? You could have the greatest business in the world, but if you overpay for it, it becomes a terrible, risky investment. At the end of the day, the risk you should be afraid of isn't a down month or even a down year in the market. It's the permanent loss of your money. So managing risk is all about making sure you don't make mistakes that take you out of the game for good. Okay, so that's the philosophy. How do we actually put this into practice? Well, Klarman gives us a really clear framework, and it's all built around that central idea of the book, the margin of safety. And listen, this isn't just about finding a cheap stock based on some single metric. I want you to think of it like building a fortress. A real margin of safety is a robust defense system, and it's built with several independent layers of protection. Let's look at how they all work together. First, the business quality. This is your fortress's strong foundation, a durable company that can survive any economic storm. Second, the price discount. This is your big, wide moat. You absolutely must buy it for way less than you think it's worth. And third, structure and sizing. These are your supplies inside the fortress. You structure the investment so that a market panic, a long siege, doesn't force you to sell at the worst possible time. And there it is, the simple but incredibly powerful formula. All three of these elements have to be there. A good business, bought at a cheap price, in a size you can handle both financially and emotionally. If you remove any one of those, your safety net is completely gone. And this is a point worth screaming from the rooftops. It is so easy to fall in love with a fantastic company. But if you pay too much for it, you have no margin of safety. You're just betting that the future will be even more perfect than the crazy high price already implies. And that's not investing. That's just pure optimism. Now look, having the right formula is one thing, but having the discipline to actually follow it, that's a whole different ballgame. Klarman's philosophy is just as much about psychology as it is about finance. An elite investor knows that their real edge comes from what they don't do. So many people lose because they feel like they always have to be doing something, always swinging the bat. But the master investor knows that waiting patiently for that perfect pitch, well, that's the whole game. Sometimes the best trade you can possibly make is no trade at all. And this is where holding cash becomes a strategic weapon. For so many people, cash feels unproductive, like it's just sitting there. But for Klarman, cash is an option. It's the option to buy when everyone else is panicking and being forced to sell their best assets. It gives you the power to act when opportunity is screaming at you.
Okay, let's take all of this and distill it down into an actionable tool, something you can use right away. Before you make any investment, I want you to run it through this simple 3-question filter.
First, ask yourself what can go wrong, and be specific, be brutally honest. Second, if that bad thing happens, can I survive it? Not just financially, but emotionally too. And then, and only then, do you ask the third question. If things go right, is the upside truly worth taking that survivable risk?
This filter right here is the dividing line. If your analysis of the downside is fuzzy, or if you know deep down that a bad outcome would totally wipe you out, then you're not investing. You are just hoping for the best. And hope is not a strategy.
So, if you only take one single thing away from this whole explainer of Klarman's classic, let it be this. Focus all your energy on understanding and controlling what can go wrong. Master your downside, and I promise you, the long-term returns will follow.
We'll end with this provocative thought, which really gets to the core of Klarman's entire philosophy. Price movements are opinions. They're not commands. The market offers you opportunities every single day. So the real question is, are you its master, or are you letting its manic swings make you its servant?